Hi, this is Roger Balser, and welcome to our 2-Minute Tuesday for August 11th of 2015. Our title for this week is Take a Hike. One of the questions I'm most frequently asked is, will the Fed raise rates in September, and what will happen to the market when they do? Unfortunately, I don't have a crystal ball to know when rates will rise and cannot proclaim, bond investors, beware the Ides of September. While it's impossible to know what's going to happen in the future, as the situation changes every day, today I'd like to look back at previous rate hikes to see how certain asset classes handled rate hikes. So if interest rates do rise, how will the U.S. equity market handle it? Will gold skyrocket? What will happen to European equities after rate hikes? In some cases, the answers are quite surprising. To provide this analysis, I turn to my good friends at Dorsey, Wright & Associates, who performed a study to see how different areas of the market, ranging from U.S. equities to gold to developed markets, reacted to a Fed funds rate hike. They determined when the rate hikes took place, which usually began in 1972, using the Federal Reserve Board of Governors page provided by the New York Federal Reserve. The purpose of this study is to give you an idea of what you can expect to happen to certain asset classes during the initial periods of a Fed funds rate hike. As you can see in the table, which aggregates all the asset classes together, you'll notice some rate hikes lasted only a few months, while others lasted a few years. During rate hike periods, beginning from the hike day to the first day of the rate decline, U.S. Treasury bonds were the only major asset class to have a negative return. It's not surprising at all. There were, of course, periods when the U.S. Treasury bond ended the rate hike period in the black, but overall, rate hikes were often detrimental to bonds. U.S. equities, both large cap, which is the S&P, and small cap, which is the Russell 2000, benefited from the Fed funds rate hikes. During the most recent hike, which occurred between June 30th of 2004 and June 29th of 2006, the S&P 500 was up 11.35%, while the Russell 2000 was up 22.51%. Interestingly enough, going back 30 years, the S&P has produced positive gains 4 out of the last 5 times the Fed hiked rates. The dollar has seen an average return of 0.53% during the hikes, and the trend of its returns has not been as consistent as some other asset classes. Gold, on the other hand, has been the best performing asset during rate hike periods, up an average of 29.76%, most of which is due to the few hikes during the 1970s. It struggled in the early 80s, but during the recent hikes, it's been up an average of 36.98%. One surprising area of strong performance during rate hikes is the EFI, or the developed markets ex-US and Canada. Going back to 1972, EFI is up an average of 8.45% during hikes, and since 1972 has only been down twice during the hikes. But don't get ahead of yourself. When we look at how these assets performed after the initial rate hikes, the picture becomes clear, and interesting enough, sometimes the assets that rose during the hike did not continue rising. U.S. Treasuries, not surprising, were down 12 months after the rate hike. Remember gold? Well, it turns out gold wasn't able to sustain the positive run it established during the rate hike, and as it ended up underperforming during periods after the rate hike. Equities, both domestic and international, reacted favorably to the hikes. Small cap was up an average of 15.23% during the 12-month period, while the S&P 500 also performed well, seeing as the index was up an average of 7.36% during the 12-month period as well. Developed markets was another surprising performer, as it was also up during the 12-month period after the hike. So when you hear all the talking heads on TV predicting the market will crash after the interest rates are hiked by the Fed, please don't listen to them. As we say at Balser Wealth Management, when the charts change, we will change.